Markets in chaos, stocks collapsing worldwide, millions losing their jobs, global recession fears rising. These headlines appear every time the economy crashes. Stock markets fall. Businesses collapse. People lose their homes. Savings vanish overnight. For millions of people, a recession feels like a financial apocalypse. But here's something strange. While the majority of people are losing money, a small group of investors are quietly becoming extremely wealthy. In fact, some of the biggest fortunes in history were built during economic crashes. Which raises an uncomfortable question. If recessions are so devastating, why do some of the richest investors in the world secretly love them? Billionaire investor Warren Buffett once said something surprising. He hopes to see more recessions in his lifetime. That sounds almost insane. Why would someone wish for an economic disaster? And more importantly, what do they understand that most people don't? Because hidden inside every recession is something most people completely miss: an opportunity. And if you understand how it works, the next recession could become the greatest financial opportunity of your life. But first, we need to understand something critical, because the biggest mistake people make during recessions actually begins long before the crash even happens: the hidden engine of the economy. To understand recessions, we first need to understand how economies grow. Every country measures its economic health using something called GDP, Gross Domestic Product. It sounds complicated, but the idea is simple. Every time someone buys something, coffee, clothes, cars, groceries, services, that money becomes part of the country's GDP. When people spend more money, GDP grows. Businesses earn more profit. Companies hire more workers. The economy expands. But when people suddenly stop spending, the opposite happens. Businesses earn less money. Companies start laying off employees. Income disappears. And once millions of people lose their income, they stop spending even more, which creates a dangerous spiral. If GDP shrinks for 2 consecutive quarters, economists officially call it a recession. But here's where things get interesting. No one can perfectly predict when a recession will happen. Not economists, not governments, not even billionaire investors. And that leads to the first rule of investing. Nobody can predict the market. If someone claims they know exactly what the stock market will do tomorrow, they're probably wrong. Markets are influenced by thousands of variables: interest rates, political events, technology, consumer psychology, global conflicts, even pandemics. Predicting the exact timing of a recession is almost impossible. But here's the paradox. While nobody knows when the market will crash, history shows us something remarkable. The market always crashes eventually. Every economic boom ends. Every bubble bursts. Every generation experiences at least one financial crisis. And that leads to something even more important. Because if crashes are inevitable, then the real question becomes this: why do some people walk away from recessions richer while others lose everything? The answer lies in something surprisingly simple. The market always recovers. Here's a pattern most people ignore. After every major financial crash in history, the market eventually recovered. After the Great Depression, markets eventually recovered. After the dot-com bubble, markets recovered. After the 2008 financial crisis, markets recovered again. In fact, after the 2008 crash, the S&P 500 eventually reached record highs, which means something extraordinary happened. The investors who bought during the crash made enormous profits during the recovery. But here's the catch. Buying during a crash feels terrifying, because during recessions, everyone around you is doing the opposite, which leads to the most important rule of all: do not panic. When markets crash, human psychology takes over. Fear spreads rapidly. People see their investments losing value, their retirement accounts shrinking, their homes dropping in price. And they panic. They start selling everything: stocks, properties, assets, anything they think might lose value. But here's the strange part. When everyone sells in fear, prices collapse. And when prices collapse, something incredible happens. Everything becomes cheap. Stocks become discounted. Real estate becomes cheaper. Businesses become undervalued. In other words, the entire economy goes on sale. Which raises a fascinating question. If everything becomes cheaper during a recession, why aren't more people buying? The answer is simple. Because most people are too afraid, and that fear creates the biggest opportunities. The preparation stage. The smartest investors understand something critical. The best time to prepare for a recession is before it happens. During economic booms, people behave very differently. They spend more money, they take on more debt, they buy bigger houses, they finance expensive cars, credit cards fill up quickly, everything feels safe. But history tells us something dangerous about economic booms. They make people overconfident. And overconfidence leads to financial vulnerability. While everyone else is celebrating prosperity, smart investors quietly prepare for the next downturn. They save money. They reduce unnecessary spending. They avoid excessive debt. They build strong credit scores. Why? Because when the recession finally arrives, they want to be ready. Ready to buy assets when everyone else is selling. And that moment of panic creates one of the greatest financial opportunities in the world. But where exactly are those opportunities hiding? Let's start with one of the biggest. Opportunity 1. Real estate. Real estate markets behave very differently during recessions. When people lose their jobs, many homeowners can no longer afford their mortgage payments. Some are forced to sell their homes quickly. Others lose their homes entirely through foreclosure. This creates a sudden surge of properties entering the market. At the same time, fewer people are willing to buy homes. Demand falls. Supply rises. Prices drop. To most people, this looks like a disaster. But to prepared investors, it looks like a clearance sale. Properties that once cost hundreds of thousands suddenly become available at deep discounts. Investors with savings and strong credit can purchase these properties. Then they have options. They can rent them out, creating steady monthly cash flow. Or they can hold them long term, waiting for the housing market to recover. And historically, it always does. But real estate isn't the only opportunity hiding inside recessions. In fact, one of the biggest opportunities might be hiding inside something you probably check every day. Opportunity 2. The stock market. During recessions, stock markets often collapse dramatically. Investors panic. News headlines predict economic doom. People rush to sell their shares before prices fall even further. But here's something fascinating. Many of those companies are still strong businesses. They still generate revenue, they still create products, they still serve millions of customers. The only thing that changed is investor emotion. During the 2008 financial crisis, the S&P 500 fell roughly 35%. Fear dominated the market. But investors who bought during that crash experienced something remarkable. Over the following decade, their investments multiplied several times. What looked like a catastrophe was actually one of the greatest buying opportunities in modern financial history. But the opportunities don't stop there. Because recessions don't just create cheap investments, they also create entirely new winning businesses. Opportunity 3. Businesses that thrive during crisis. Not all businesses suffer during recessions. Some actually grow faster. For example, discount retailers often thrive during economic downturns. When people struggle financially, they search for cheaper alternatives. That's why companies like Walmart and Dollar Tree expanded during the 2008 crisis. But another category of business also grows during recessions. Entertainment. When life becomes stressful, people crave distraction. Movies, streaming services, video games, social media. Escapism becomes incredibly valuable. Even companies like Netflix saw massive growth during economic uncertainty. Because when the world feels chaotic, people search for small moments of relief, which reveals an important lesson for entrepreneurs. The businesses that succeed during recessions are usually the ones that solve immediate emotional problems, the psychological advantage. In the end, the biggest difference between people who profit during recessions and those who suffer is psychology. Most people react emotionally. They panic, they retreat, they sell everything. But successful investors behave differently. They remain calm, they follow long-term strategies, they understand something most people forget. Recessions are temporary. Economic cycles always repeat. Boom, crash, recovery, growth, and every crash creates the foundation for the next economic expansion. Which leads to one final thought. History guarantees one thing: another recession will happen. We don't know when, we don't know why, but economic cycles always return. And when the next crash arrives, millions of people will panic. But a small group of prepared investors will quietly begin buying because they understand something powerful. Every financial storm eventually passes. And when it does, the people who stayed calm during the chaos often come out far ahead. If you enjoyed this video and found it valuable, make sure to hit the like button so more people can discover it. And if you want to see more cinematic documentary videos about finance, economics, and the hidden forces shaping our world, consider subscribing to the channel and turning on notifications. You can also share this video with someone who wants to better understand how money and markets really work. Thank you so much for watching, and I'll see you in the next video.